What is up, YouTube? This is the Working Investor. In this video, we are going to look forward into this coming group called Group A, because Group A actually is going to be paying 2 times in this month. You see here, December 2nd is going to be the payment of Group A, a little bit later because of the holidays. And then you see here at the end, the last line, Group A, is going to be December 30th. So let's look at Group A, and we're going to talk about total returns of all the underlyings of Group A. I also realize I have to add the total return of YMAX and YMAG because they are also in Group A. So let's get into the video of total return comparison. Before we get into there, let's look into YMAX, and I'm going to look into the timeline. Let me show you the timeline and why I'm using this timeline. So we're going to use a timeline of August 21st, 2024 to November 24th, 2024. The reason why I'm only using this limited timeline is because one of the underlyings in Group A, TSMY, was launched. It's the most contemporary fund. It was launched August 21st, 2024. And when it comes to comparing apples to apples comparison, you want to compare total return to total return, but you also have to compare the same timeline. It's not fair to use total return of 6 months or a year of one underlying to 2-3 months of another underlying. So that's why we're going to keep everything in an even playing field. The benchmarks we're going to be using will be QQQ, which in this time period, which is just about a little bit over 90 days, so just about a quarter, which is still a nice amount of time to look into, it produced 4.97%. SPY, the S&P 500, actually outpaced the NASDAQ and produced 6.55% in total return. I have to say total return because it includes price, change in price, and you have to also factor in the dividend. So it factors the whole picture in. IWM, which is the Russell 2000, actually did even better than the NASDAQ and the S&P 500. They have 11.2%. And Bitcoin, we're going to use Bitcoin as one of our benchmarks because we do have Bitcoin correlated assets. So I do want to have Bitcoin in there as a benchmark and just for reference to see if it's how it's doing compared to a reference benchmark. And BTC to US dollar is 62.71% in this 3-month span. So let's go. Let me add YMAG and YMAX to it. So this is what I do, and you guys could do it yourself. So you go to Seeking Alpha, go to charting, and always look at select metrics. Type in TOT because you're looking for total return. Press update chart, and then very important, go to the calendar, and I'm going to go to August 21st because that's our metric. Press apply. You can even check here, and you can see it's August 21st onward until today's date, which is November 24th. Press apply, and you're going to see over here that YMAX, which is YMAX's compilation of all their cover call ETFs, single stock ETFs, they only have a price return of 1.66%. So to a lay person who's not looking at total return, they'll be like, oh, this is a poo-poo fund. It's only 1.66%. IWM gave about much more than that. But if you look at total return, it's 13.93%. When you see the whole picture, you'll see that they actually did better than the Russell. So 13.93%. So we're just going to put that in there for YMAX, and it's 13.93%. And obviously, we've seen consistently that YMAG has outpaced YMAX. I wouldn't be surprised. Let's look at YMAG. We're going to do the same exercise. And just make sure sometimes you have to refresh it a little bit because sometimes it has the old data. So let's just, so YMAG versus S&P, charting, chart metrics. We'll look at total return, press update, and make sure you use the same timeline. Otherwise, it's not fair. August 21st, you can even check to see August 21st and onward. So this is about just over 90 days. Actually, surprisingly, I thought YMAG would outpace YMAX. So surprisingly, YMAX did better than YMAG in the past 3 months. My assumption would be because YMAX has a lot of crypto-based underlyings like Misty, Coney, YBIT. So that could be the reason why. But I've seen, in longer durations of time, YMAG has outpaced YMAX, but recently not. So 9.4%, but still, I would not say this is bad at all, because if you look at YMAG, and you compare it to, let's say, the Qs, because the YMAG is basically the Magnificent Seven, which is the Qs, 4.97%. So something to give me about double the yield, almost double the yield of the Qs. I would not discount that at all. So let's go into one by one. So we have TSLY. So TSLY returned 33.61%. I'm also using the benchmark of the underlying, how they underlying performed, and how much of the performance of the underlying did the cover call writing capture. Because of course, with a cover call or synthetic cover call ETF, even with the opportunistic call credit spreads, they're limited. That's the name of the game. You're limited how much you can capture in the upside. So you see TSLY captured 33% of the 57%. So not too bad, but obviously you leave something on the table. But again, it's an income-based fund, and you cannot discount a 33%, 33.61% when it tripled the Russell. It multiple times over did better than the Qs. Crash, which is the inverse, has been the worst performer in a total return standpoint. Yes, factoring in the dividends in the same time period. Not surprisingly, because the market's been up, the inverse of Tesla, which is Crash, has been down 35.16% in a total return. It's been down worse than that, but if you factor in the dividends, it makes it not as bad, but it's still negative 35.16%, while Tesla's up 33.61%. Then you have GOOY. I'm honestly not too happy with GOOY. Because GOOY has a total negative return in this 3-month time period of 3.2%. So it's down total return standpoint, including factoring in the dividends, 3.2%, while its underlying GOOGL, Google, is negative 0.53%. I would expect that a cover call ETF would outpace the underlier in a neutral to down market. And Google obviously went down recently, so I was hoping it at least match, if not overperform, even if it's down a little bit or zero. But I was not too happy with that type of performance. YBIT, see, on face value, YBIT is amazing, because YBIT, they do options on certain underlyings such as BITO. And I recall from the interview with Jay is the fund manager, one of the fund managers or the sub-advisors of YMAX. And he mentioned that their prospectus is terminology does not limit them to only BITO. They can use other crypto correlated assets. They may go to other ones. But YBIT in this period of time performed 28.47%. Not too bad. Again, beating all the major equity indexes, coming short from BTC to US dollar by half, almost less than half the performance of that. And if you want to compare YBIT to what it trades on, BITO. BITO itself in that period of time, returned 58.82%. I know myself and a lot of other investors, they tend to like to own BITO itself, collect the dividends, and then write our own cover calls, and then you kind of could get closer to the price of Bitcoin, if not greater. But there is a shortcoming to that, because YBIT does options on BITO. That's how they derive their income. Owning BITO, they roll the futures from month to month. And basically, when Bitcoin was going down, the payouts were really, really small. So it's not always very reliable. But it is what it is. I just want to present the information out there. Then there's ARK, Kathy Wood's fund. It's trading on RK, so OARK from YMAX. So OARK in this time period performed 15.3%. Nothing to laugh at. It beat all the equity indexes, but relative to RK, it captured a portion of that, which that one performed 23.24%. I believe RK was down for the longest time, and now it just kind of popped back up again the past quarter. Probably because it has a lot of, stuff that would be propagated with the change in the socioeconomic status. ExxonMobil, even though, compared to the YMAX funds, not the best, not the worst, but if you look at XOMO, XOMO, compared to its underlying XOM, you could see that it captured almost the entire upside of XOM. So that's definitely something that speaks volumes, and also 6.93% beat the, it's doing outperforming the S&P 500 in the same period of time, underperforming the Russell and of course Bitcoin, but it's not a Bitcoin asset, so you can't really compare that to that. Then you have SNOY, 24.92%. I have to say, from a cover call writing standpoint, if you look at all these funds in this period of time, SNOY did better than the underlying of SNO. Like SNO performed 23.97%. SNO is the only one that actually total return standpoint, a person, if they bought them exactly, those dates and held them for this period of time, they actually would be better off with SNO than SNO for an income fund as a total return. But you also have to factor in taxes. So that's something that can you don't see behind the scenes. But pretty good, 24.92%. TSMY, 5.23%. And its underlying, which is actually, I should add it here, TSM, what am I saying here? TSM did 11.28%, so maybe about less than half. And then YMAG, like you saw earlier, 9.4, YMAX 13.93. Like I said, this is only a smaller snapshot in time. We're talking about the last quarter, 3 months. If you look at other videos that I've made, you could see if you zoom out a little longer in time, YMAG on a total return standpoint did better than YMAX. But things change. The past performance is not indicative of future gains and future results. So who knows? Who knows? Because it's a crapshoot. Because YMAX has everything that YMAG has, but then it also has some better stuff, some worse stuff. You know what I mean? So it's I can't really tell you which one is better or worse. It depends what your risk tolerance is, what your risk profile is. None of this is financial advice. None of this is giving any advice. I'm just here to present the data, give you my little play on it as a retail investor. Please go to your financial advisor, your tax people, your lawyers, whoever you need to speak to make good sound and read all the prospectuses and all the risks. Anyways, this is the Work Investor over now. Have a wonderful weekend.